Donald Trump moves back into the White House on January 20th, 2025, and as expected, bonds are getting crushed already as markets price in more inflation and higher U.S. debt risk. There's more risk for Canadian mortgage rates today than there was yesterday. Now, we need to step back and take a look at two types of interest rates for mortgages here in Canada. There are variable rates, which are impacted by the Bank of Canada and its rate targets, which are primarily done for the purpose of either battling inflation or for boosting our domestic economy. And then there are fixed interest rates. Those are generally priced against the Government of Canada bond, most commonly the 5-year fixed rates following the 5-year Canada bond. But importantly, the 5-year Canada bond generally follows the US 10-year Treasury bond. Right here on the screen, I do have that graph. In blue, we have the United States, and in red for our maple leaf, I've got the Canada one. You'll see every time that the blue one goes up, so does the red. Every time the blue American one goes down, so too does Canada's. It's not always exactly the same amount, but the trends are almost always the same. And this goes back over 10 years. Canada's 5-year bond this morning initially was up only 6 basis points. The US 10-year Treasury bond was actually up 18 points at its beginning. That's a huge overnight impact. And truthfully, given the odds of a Republican White House Congress double play, plus likely control of the Senate, it is certainly possible that more of the proposed economic policy changes from the Trump campaign will happen. Now, one policy of note is that of proposed tariffs. The Trump campaign has proposed massive, broad tariffs of 10% on everything, likely more on China. We don't know what that's going to have on the US-Mexico-Canadian trade agreement, formerly known as NAFTA. But as these things roll out, if there are tariffs on goods that are imported into the United States, that is going to have an inflationary impact in the United States, which will in turn provide further upward pressure on US bond rates. And by extension, we're going to see that upward pressure on Canada's bond rates. On the Bank of Canada side, the market is now pricing in a 40% chance of a full 0.5% drop in December, on December 11th, and a 60% chance of it being at least 0.25%. So basically, that's a 100% chance of a drop, whether it's 0.25% or 0.5% that is up for negotiation and unknown at this point. Further expecting for sure at least a 0.5% drop by the end of the January rate announcement, which will happen right toward the end of that month. If you look at the overnight index swap markets, that they're currently betting on a 0.75% rate drop by the Bank of Canada by March. So if that's quarter in December, quarter in January, quarter in March again, but they're also forecasting fixed interest rates to be kind of unchanged where they're at right now. So then March would be the approximate crossover point where the variable rate mortgages become lower than the 5-year fixed rate mortgages. And that will be the first time in nearly 3 years. Starting at that point over the next 5 years, the variable rate mortgages are expected to be generally under the 5-year fixed rate mortgages. On the screen right now, what I'm showing you is the expected what we call uninsurable rate. So that's the highest of the mortgage rates that you can get, but it's showing the expected trend on both of those. Now, if you are looking at a mortgage now, the 5-year variable might very well be the best choice compared to the fixed rate options. Now, remember, variable rate mortgages always have the option to convert to a fixed rate mortgage. So if this trend is wrong and fixed rates do come down, then you do have the option of making that conversion for a better or lower level rate if that's available in the coming few years. If you like this content, please click on like for the video, maybe drop a comment, and of course, subscribe to the page and hit that bell for notifications. So with that in mind, we don't for sure know what's going to go on, but we are likely to see less downward pressure on the rates than we have seen more recently, more upward pressure or stabilizing pressures on those fixed interest rates. We're still expecting downward rate movement from the Bank of Canada, maybe a little bit less of it from the US Fed as they lower their rates. But it all remains to be seen. We will have to keep monitoring this. I'm going to continue to share this with you as we move forward.